Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from chartsandmarkets.com runs down the major markets. He tells us transports are at an all-time high and utilities have bounced back. Chris Vermeulen from the technicaltraders.com examines the Dow, bonds, the U.S. and Canadian dollars, copper and crude. He explains why Bitcoin makes him nervous. David Skarica from addictedtoprofits.net reports from the Bahamas. He points out the hazards of going to negative interest rates and the positives for junior gold miners. Plus, at the end of the show, we'll have a company showcase update from American Manganese President Larry Reaugh. We'll talk to Ross Clark right after this.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at AMYresources.com.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Always a pleasure, Jim.
Ross, transports, have they done something special this week?
Sure they have. You know, if you can't go out yourself, then you have things brought to you. And to get it to the house, gosh, it's either got to be on a train or it's got to be on a plane or it's going to be in a delivery truck. So everybody from the CP and CN railways to the cargo jets, the UPSs and FedExes are doing exceptionally well. And a week ago we started to get upside exhaustion readings in FedEx. Now we've got the not just FedEx into that mode, but you're getting these rail lines that are starting to really take off on the upside. So here's the transportation index at all-time highs, and as long as you've got some fiscal stimulus going along, which seems to be ready to happen or stay with us in perpetuity, there's some bids underneath these. So, it's been a real switch over when you think of the FANGs into the middle of August were the big winners, and they've just been doing a lot of backing and filling right now. No major upside moves. They get 3 or 4 days up and then back off again. So I think we still look for consolidation as far as that side of things is concerned. The Dow is interesting. The industrials. We look at these sequential models where you get it's a 2-part system. You get these 9 consecutive bars that are moving in one direction, whether it's up or down. So in this case, you get 9 consecutive bars up, and then you start to do another countdown process where you're looking for 13 days that are higher, that close higher than the high of the previous 2 days. And they don't have to be consecutive days. These can take they could take a month and a half to build. Well, that sequential 13 provided sell signals back at the end of January, just prior to the February break in the market. They were in place at the bottom a day before the low. Kicked in August, just right at the end of August on the 28th before we took a good correction. And the reason I bring it up right now is that the count is back out to 10 of a potential 13. So if we are to see some strength here in the Dow Industrials over the coming week or two, where we get 3 more days that are above 2 days earlier, this will kick in that signal, and you could very well end up with a decent correction prior to the election in November the 4th. So that's high on the list right now, even though you're not seeing a lot of activity and momentum in the market as far as the industrials are concerned. They only have to inch higher here to provide that type of a signal.
What's going on with utilities?
Utilities, just like the transports, are showing some life, not as much, but clearly it's the money has been moving more back to safer havens, as I would say, these days. And here's the utility ETF has gone from 56 and change up to 64 in the last 2 weeks for a utility index. That's pretty darn good. And it's still well shy of the highs that we put in back in January, but got an upside bias to it in here. And of note, the bonds, once again, thinking in terms of return on investment rather than return of investment, the bonds have been since March looking like they were topping. They had a big spike up as interest rates bottomed in March, and the bond market had been slowly rolling over to the point where a week ago the commitment of traders numbers from the Commodity Futures Trading Commission shows us the positions of the commercials and the speculators in the futures of various contracts. And in the bond market, the short position of the speculative and funds was at a record high. They had over 290,000 contracts short. The commercials had their biggest their net long position since back in 2006. So extremes like this are ones that you look for around significant turns. So the bond market had a pretty good week this week, and looks as though even it might have a pause here in this little rally. It's probably got some pretty good legs underneath it for the next little while, which is going to surprise a lot of the speculators who are on the wrong side of that market.
What's going on with precious metals?
Well, we've been happy with the action in here. We had our exhaustion signals back in August. We've gone through 10 weeks of consolidation, having tested the support levels twice. Got that great buy signal 2 weeks ago that sparked a rally in gold back over 1900 and a good rally in silver. Of note, the consolidation here that we're into probably is setting up for a test of the sort of 1970 to 2000 level as far as gold is concerned, and silver probably in the $26.5 to $27 level. But it's going to need a catalyst. We have some support that's under here. Might get tested one more time, but if these markets, the gold and silver, close above their 50-day averages, then I think you're going to see a pretty quick move, probably in the span of like 4 to 5 days, for them to run up and test those resistance areas. They would be roughly a 50 to 60% retracement of the drop that we had from the August high, and that's very, very normal for the action that you would see after that speculative blow-off that we had in July, August.
How are our so-called Robin Hooders doing?
Well, I don't know at this point. There's a lot of them out there with a lot of new positions or accounts being opened, and I just wonder, with the experience or lack of it that these novices have, and so many of them are young people who had government support programs helping them out, and are maybe now backing off on that and finding that with some of those checks they got, if they were nimble, they could make some pretty good money by day trading. Well, I've never seen day traders who have had any prolonged ability to make money. And I would suspect that as we go through rotations, as we have out of FANGs and into renewables and solars and now into transports, etc., that they're going to get caught on the wrong side of things. As markets start to correct, when you don't have a lot of experience and maybe you've got a a target you've been looking for. I've made X number of dollars, but I need to have so much more. Those kind of things can get you in trouble. And once markets turn, I saw a lot of this back in the dot-com days when people were making, very big money in late 99 and into early 2000. Well, by the time we got halfway through 2001, there weren't very many of them who were trading anymore. And I just say to anybody who's out there with lack of experience, if you're finding some windfalls, make sure that you put some of that money away and in a nice safe place where you won't be tempted to bring it back out and overtrade.
And of course, they can also get advice from Charts by Ross.
Well, Charts by Ross, or, a financial advisor who's been around for a while and is going to teach them some lessons that they don't have to go through the fire to learn, that they can learn by talking to people who have already learned the lessons the hard way.
Ross, thank you so much for being on This Week in Money.
Good to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. You can find him on Twitter at Charts by Ross. Coming up, Chris Vermeulen next on This Week in Money.
Always consult your investment professional before making any investment decision.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Chris Vermeulen from thetechnicaltraders.com. Welcome to This Week in Money, Chris.
Hey, thanks for having me, Jim.
People who are new to the Technical Traders, what's the company all about?
Yeah, the Technical Traders, it's exactly what it says. We focus on technical analysis, which is the study of price action on the charts. We don't use news. We don't follow fundamentals. We purely follow price because we believe that the only way as a trader or investor that we make money is when price moves in our favor. So we follow it, and we follow it very closely, and there's all kinds of amazing tools and strategies that allow you to take advantage of the financial markets without having to deal with the news and the media and surprise earnings and things like that. So we are very logical technical traders here.
Chris, what do you see ahead for the Dow, short-term and then long-term?
Right. Well, short-term, the markets in the past few trading sessions have they've turned up. We've kind of got a short-term buy signal on the major indexes, including the Dow, the S&P 500, and the NASDAQ. So they're all moving to the upside here. I think a lot of people are expecting some type of stimulus plan, whether it comes before or after the election. I don't really think it matters based on how prices have been moving. People are expecting support. So I think in the short term, you should still be looking for higher prices in the stock market. Longer term, I think we are starting to struggle a little bit. And depending on the index, I mean, you're talking Dow here, which to me is kind of the economic stocks. You're looking at the major companies that kind of show the broad strength of the economy, and it's not making new highs on the year, and neither are the small cap stocks like the Russell 2000, and that's not a good sign. New York Stock Exchange, same story. We're not making new highs on the majority of stocks. So longer term, I'm actually pretty bearish on the stock market just because we're not seeing broad market participation in this rally. We're seeing technology, biotech, just some leading sectors really doing all the heavy lifting. So I think looking forward 6 to 8 months from now, I think we're going to be having a tough time in the stock market. We could be trading sideways or much lower from where we are right now. I just don't see the market extending too much higher because I feel like we're in this euphoric kind of buying stage by the average investor piling into the stock market, which is seen in the NASDAQ really clearly in the technology stocks. So I think we're getting to a fragile point in the stock market where I think most of the upside is done, and we could go into a consolidation like 2015 where we trade in a big sideways range for potentially a year or so.
Are we likely to see any surprises in the bond market and interest rates?
Yeah, the bond market's pretty interesting. I mean, it has formed a multi-month bull flag, and a bull flag means it's a bullish pattern, so price should resolve to the upside once this pause has taken place. But the thing is, the interest rates are so low. Based on the forecast of where the U.S. dollar is going, which is they're expecting the dollar to go down about 1.5% on average per year. Well, bonds, you're only making 0.75%. So you're actually going to be losing money or buying power just by holding bonds. And there's just not enough interest there to make money. So it's a really tough call what bonds are going to do. They've been in like a 30 or 38-year bull market. People are starting to lose some faith in what's going on, and there's just not real money to be made in the bond market. So we could see the bond market move back up, maybe test those February, March highs in the bond market, but I think it'll be short-lived because there's really no return on your money there. It'll really just be if the stock market does start to sell off or trade sideways and people get nervous, the average investor is going to tell their broker or their financial advisor, you know what, I'm not comfortable, just put me in bonds. And just the general masses kind of making that slow transition to a comfort position will just kind of move bonds up. But I don't see any big upside potential in the price of bonds.
Your thoughts on the U.S. dollar?
Well, the U.S. dollar, I mean, stimulus is never really a good thing for the U.S. dollar. It's been under pressure for a while here. But the thing is, I think it's finding some short-term support. And there's some fear in the market. And when we see fear in the stock market, just like back in February, March, people liquidate positions and they move to the most stable, strongest currency that they believe in, which happens to be the U.S. dollar. We've seen it happen time and time again. And the U.S. dollar rallied about 12% during the March crash in stocks. So the dollar, as much as I'm kind of bearish with the stimulus that's about to be unveiled and unfolding over the next several years, the thing is, if people still believe in that currency strong enough, it doesn't matter what the fundamentals say. People are going to continue to buy the dollar. It's going to be the global reserve currency, and it could actually move up and hold its value very well. So I'm not really bearish on the dollar simply because I think it's still going to be seen as a global reserve currency, although the fundamentals go against it. But again, fundamentals and price really don't mix. They're not great for timing each other.
How does the Canadian dollar look?
Well, the Canadian dollar has been kind of bouncing bottom since 2016. It's trying to build a big base, and it's really tied to the price of crude oil because it's just what Canada has a lot of weighting on. Overall, I think the Canadian dollar is probably going to hold its ground where it is. It's around the 75-cent mark or level. I don't think we're going to see it crash in a big way. I think it'll hold its value compared to other currencies, but it's really tough to say. It's at the lower end of a range cycle-wise. It really should be starting to firm up over the next few years. We're really, I think, coming into a major super cycle for commodities, which maybe we'll touch on in a little bit. So at this point, the dollar, I think it's going to hold some value for a couple of years, but I think there's a lot of upside looking forward a few more years here.
Could gold and silver have seen their highs for 2020?
I think it's very possible that they have seen their highs. If anything, we might go back up and test those highs, but I don't see us really extending too much further beyond those. And based on some cycle analysis, I think we're going to see the stock market continue to chop around and potentially grind higher here into the holiday season, into December, the end of the year. And I think precious metals could actually become a favored sector. The silver miners and gold miners are actually looking really strong. They haven't broken out yet, but they have a pattern that shows a very strong rally. And I think they could become the leader going into year end. So I think the gold and silver may not run as much as the gold miners. But I do think they will be moving up going into 2021.
What do you see ahead for gold in 2021?
I think we're going to see some overall weakness. Like you just said, I feel like we've kind of seen more or less the highs for a little while. And if the stock market does go into a sideways trading range or trade lower over the next 6, 8, 12 months, it's most likely going to pull metals down with it. We've seen this happen time and time again. The wild card is what's going to happen with COVID and stimulus. And the more stimulus that goes out, the more bullish it actually is for precious metals. So it's going to really weigh on how much stimulus gets pumped into the economy. But I think they're going to probably struggle for several months, 3, 6, 8 months. But I do think they're going to end the year 2021 at all-time highs, and they will be starting a new pretty major bull market to the upside.
What do you see ahead for silver in 2021?
Yeah, I kind of move gold, silver, and the miners really into one basket. So it's pretty much the same scenario. Silver's just a lot more volatile than gold. So if gold pulls back 10 or 15%, silver could pull back 20 to 30%. But overall, they typically move together. Silver tends to lag a few weeks or a few months before gold, or after gold, to put it that way. If gold breaks out, silver follows suit, usually a little bit after, but overall bullish on silver as well.
What's the latest on the silver shortage?
When silver broke into that bull market earlier this year, we saw that silver shortage really just skyrocket. We saw the shorts cover. There was not enough contracts to be filled. It was pretty interesting on how prices moved, and there's a lot of sides to this story depending on what you believe, but I mean, people still think there's not enough silver available, and there's a lot of fake numbers going around. Overall, I mean, silver really does have a very bullish picture long term, just because there is a silver shortage. It's a very kind of leveraged move. I think when it starts to run, it's going to have the biggest percentage gain, and there's a lot of physical deliveries of silver being demanded, and that's where we're running into this shortage. So I think it's going to be a continued growing demand, and eventually I think the shortage for both gold and silver long term, I think is what's going to create a giant spike, because really the precious metals market isn't used to taking big deliveries. This year we've been seeing some record deliveries on these delivery months for futures contracts that we haven't really seen. So I think things are just getting started where countries and institutions and individuals are actually saying, hey, I don't want to hold a currency. I don't want money in the bank system. I want a brick of gold and bricks of silver. And so I think this shortage is going to continue to be a major problem. And that's going to lead to, I think, a price spike eventually in the future, simply because there isn't going to be any silver to get or gold, and everyone's going to want it.
Is the gold-silver ratio a good indicator of where silver is headed?
Yeah, it's a good ratio. It gives you a general idea. It's not very good for timing short term, but more or less when the ratio is really high, that's when you want to be owning silver. When the ratio is really low, you want to be owning more gold. But really the key here is to really just own a basket of both, because you really never know which metal is going to go ballistic. And there is a strong argument that kind of gold potentially could become some type of currency or a backing for a currency over silver. So if that is the case, gold is actually going to shine really bright, and it's going to create a lot more demand. But based on history, we've always seen silver outperform, and so that's where you get into this mix, is where do you go? Do you go into one that's more seen as an asset like gold, or do you go to the more volatile one that has potential more percentage gain like silver? And that's when you just need to put a mix that you're comfortable with in terms of how much weighting you put in each of those metals.
We'll have more with Chris Vermeulen when This Week in Money returns.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. We're speaking with Chris Vermeulen. Chris, how is copper looking?
Well, copper's been on a tear this year. It's been moving up, and it's testing some multi-year highs at this point. It's in a strong uptrend. Looking at kind of future price here, it's really tough to say where this is going to if it's going to explode or reverse back down. Again, a lot of the next big move for all asset classes, the real estate, building supplies, copper, metals, the stock market, a lot of this is going to hinge on COVID and whether we lock down and home sales stop and people stop being able to travel and go to work and things really get tight, or if things continue just kind of bump along like we're doing right now, just grinding and making progress. So it's really tough. I mean, we've got home sales, which drives copper quite a bit. I mean, there's a lot of copper used in homes and electronics. So we're seeing copper definitely have a big move up here. Overall, I'm not a huge fan of following or trading copper. I like to get an idea of what it's doing because it is a bit of a economic indicator. It is trending up. There's big demand in the building sector, and copper's confirming that. But overall, I don't see a big, clear direction that copper is going to be going over the next few weeks or even over the next few months.
How are the base metals looking in the charts?
The base metals have been doing really well. I mean, you can the base metals and you look at other commodities as well, kind of like lumber. I mean, they've been on fire. They've been having some strong moves to the upside over this year. Things are starting to fizzle out. I think the whole peak in kind of base metals and base materials is starting to struggle. We're starting to see things calm down quite a bit, especially in the lumber. And that's also the case kind of for copper. It's run all the way up to resistance. And so now all these kind of base materials in general, I think, are kind of overextended, and I don't see a lot of direction. They're in an uptrend, but they're stuck under resistance. And so I would just steer clear of the base metals until we get some clear indication of if they're going to break out and extend to the upside or if we're going to see a contraction going forward. Again, copper base metals I don't use too much for trading and getting really any insight in terms of new positions to put on.
Chris, what do you see ahead for crude?
Crude oil's been struggling over the past month and a half or so. It broke down in September in a big way with heavy volume. It's since rebounded back up to that level where it broke and collapsed. And it's been trading there really for a month. And it's got some really big volatility. We keep seeing big rallies of 4 or 5% in a day, and then it sells off 4 or 5% another day. So it continues to oscillate with big volatility. And there's a lot of traders in crude oil because when it went negative, it brought a whole new slew of traders into the crude oil market that were never interested in it before. And so it seems like it's had a lot of volatility ever since then. It's got really big intraday moves. At this point, it has the 200-day moving average is moving down. The 50-day moving average is moving down. Those are pretty critical long-term trends. And price is trading down at those levels and stuck kind of below them. So at this point, crude oil is in the kind of reversal phase where it's not in an uptrend. It's not really in a downtrend yet. It's undecided which way it wants to go. And so we're waiting for a break on crude oil to break really above about $41.50 a barrel. If it can get above that, then we're kind of back into a new uptrend. But if we break and close below $36 a barrel, $36.25, then we're going to be in a pretty big downtrend. And I think we could fall down to the mid-20s for crude. So whichever way it breaks, there's going to be a very strong move, and that's something to definitely keep an eye on, especially to the downside, because price falls a lot faster than it rallies. Typically, it's 5 to 7 days of gains are wiped out in 1 day of selling. So if something rallies for a month and a half, or say for a year, it'll be wiped out in really like a 2-month window. So it's going to be pretty interesting to see how this year's gains could get very, very kind of wiped out here very quickly if we get a break below that 36.25 level. So that's something to watch.
Are the agriculture markets predicting food shortages?
Yeah, there's definitely been a strong surge in the agricultural market. If you even look at the companies, the agricultural ETF, the DBA, it's had a very strong rally since July, and it's holding up very well. It's doing the opposite of what crude is doing. It's above the 200-day. It's above the 50-day moving average. It has a very strong pattern, a bullish pattern that is pointing to still much higher prices. So agriculture in general has started more or less a new big uptrend, and I think we're going to see it continue to climb going forward. We've seen a lot of commodities with COVID, like rice, really take off because that's something that people, when they get afraid, they stockpile rice, water, all those things. So it's definitely a commodity sector that if COVID ramps up again, which I think is why we're seeing ags do really well right now, is because there's a fear of COVID wave 2, and people are starting to stockpile and get concerned about locking in their future contracts of these commodities.
Do you follow cycles and trends in the various markets?
I do. I actually just did a presentation this week alongside James Carville and Mary Madeline. We're in a presentation for this kind of economic time, and more or less I was talking about a super cycle that's starting in the commodity space. And if you look at the 100-year chart of gold, we're at a kind of a major phase where gold is very close, 1 or 2 years away to breaking to the upside. If we look at the commodity space in general, which includes energies, base metals, agriculture, them all, we are starting a new 20-year super cycle. Now, these are major cycles, so it doesn't happen over a week or over 1 year. It's going to take probably 1 to maybe 3 years for this new super cycle to start to the upside, and commodities are going to have this major natural lift in price, because right now we are the opposite end of that spectrum, just like we were in 1999 and 2000, where everyone wanted real estate, everyone wanted tech and stocks, and they never had a thought in their mind that they needed to go barbaric and buy a bar of gold or anything like that. And we're in that same scenario right now where everyone wants real estate, everyone wants to buy and flip, and they want to own tech companies, and nobody's thinking about going back to the basics of owning physical commodities. And so that's where we are. This market is stretched, and we're going to be starting these cycles. So the next couple of years are going to be huge. And when you look forward 5 to 8 years from now, we should have caught most of this the most powerful portion of this super cycle that'll be taking place. And it's definitely something to pay attention to.
Do you have any thoughts on Bitcoin? People keep predicting it's going to go up to $50,000 in 5 years.
Yeah, Bitcoin it's been holding up really well. Like over the last more or less year, it's had a really big pullback, and it's clawed its way back from the March lows, and it's actually formed a very large kind of basing pattern where if it can start to break and hold above more or less 12,900 or more so around that 13,000 mark, if it can hold above that level, it could really take off, and we could see a significant high in price back all the way up to 20,000. I don't see the 50. I'm not quite that extreme, but I also didn't see $20,000 Bitcoin, a few years ago. So you never know how big something will spike when it goes parabolic. But it has definitely built a base over the last year, and it is trending higher. So I wouldn't be surprised if we see chaos in the stock market and in general, that we could see people have a flight to Bitcoin with obviously stimulus, printing money. People know it's long-term going to devalue the currency. It just may take years for it to come into play. So people, I think, will be repositioning some of their money in Bitcoin.
When people argue Bitcoin is portable, you don't have to store it or pay for storage, they say that's their argument over going for gold. My argument is even if gold goes down in price, you still have something. Bitcoin could disappear with one power failure. What are your feelings on that?
Yeah, I've always had this kind of love-hate relationship with digital currencies. I'm not a fan of always relying on a super long string of codes, and that can get lost or hacked. And if you can't remember how to access it, I mean, I'm not a huge crypto fan. I like the idea of physical metals because of that. And I mean, the thing is, people are stealing and doing things with Bitcoin, but a lot of them are still actually getting tracked and hunted down and getting caught. Whereas physical gold, you can melt it down, you can hand a bar over to a friend. I mean, it really is much more private than Bitcoin. Bitcoin always leaves a trail. It's not supposed to be able to be tracked or traced, but I mean, you can't argue that people have been found through Bitcoin transactions. There's always a little trail left behind. So I like physical metals, and of course, you will always have something. I mean, what happens if there's a major war and EMPs nuke almost all the electronics that we have? I mean, you're going to be down if the internet's dropping and countries are going blackout. I mean, I don't see that happening, but it's a possibility. But you can always go dig a bar of gold out of your backyard and shave some off into a little weigh scale and buy what you need. So that's the way I kind of see it.
Yeah, and if nothing else, you can use it as a doorstop.
Exactly, or a weapon. That's a good...
Chris, how can people find out more about your newsletter?
Sure, yeah. At the technicaltraders.com is where I share a bunch of free research every day. Trade ideas, investment ideas, some trading tips and strategies on how to take advantage of these crazy market times. And as a subscriber, if you wanted to become more of an active trader or just learn about technical analysis, the trading newsletter, I offer a video every morning, an 8 to 10 minute video recapping what's happened in the markets today and pre-market. And I kind of tell you before the opening bell each day what to be prepared for and if it's going to affect any of our positions and how. And you get to learn while we trade. And I like to focus on the key hot sectors, whichever's moving in the markets, because that's where there's some great opportunity, and they typically outperform the rest of the market. So it's a great spot to just get an idea of what's going on in the markets from our free blog. But again, you can dig into the details and learn a lot more while you trade right alongside with us at the paid subscription.
Chris, thank you so much for being on This Week in Money.
Hey, thanks, Jim. Always a pleasure.
My guest has been Chris Vermeulen from the technicaltraders.com. Coming up, David Skarica next on This Week in Money.
Value from success. Growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
This Week in Money is archived online at talkdigitalnetwork.com.
My guest is David Skarica, founder of the Addicted to Profits newsletter online at addictedtoprofits.net. He also writes for the Financial Intelligence Report. Welcome back to the show, David.
Thanks for having me.
David, you're reporting to us from the beautiful Bahamas, and we were talking off air about will we see negative interest rates in North America? Do you think we will? And the effect that the COVID crisis has had in the Bahamas and what they're doing to deal with debt.
Well, I think the thing about, first of all, when you look at negative interest rates, it's kind of unfair in a way. I think there's a lot of problems with it, but in terms of the actual macro standpoint, where these Western European countries or the UK or the US and Canada are these large kind of Western economies because they have their own central banks and they can print essentially as much money as they can. They're kind of have an unfair advantage that way in that they can almost run up all this debt they want, do QE, buy their own debt, and then, like I said, one reason you would have negative interest rates would be, it all comes back to is everyone blames whatever, capitalism or the downturn or COVID or the banking crisis on this and that. But see, I have a different philosophy on the long term of why this has all happened. Is that, see, I think this is actually all a symptom of socialism to a certain extent, because what's happened is I think all these countries in the West, they all have too much debt, and they have these social welfare states that are just too overly expansive that came in after World War II. And due to their poor demographics and just overspending in general, they really can't afford these things. So one reason you keep having these bubbles in economy and then these blow-ups and then all these shenanigans, like you're talking about negative interest rates, is because they have to basically do these things to try to keep the beast, the government, alive so they can afford all of these programs that have been instituted, which really, the mass welfare state in the Western world, was really non-existent, existent before, say, the 50s, before after World War II. So it's a really short period of time this has gone on globally in the global economy. So that's why I think they're doing that. So then I say it's an unfair advantage because smaller countries like the Bahamas or even in countries in South America that economies aren't as developed, or they're just, like I said, they're just smaller countries. The issue they have is they can't put their own money to buy their own bonds, and they're kind of at the whim that if their government finances go down the toilet, their interest rates will go higher. Like one thing I was discussing with you off air is that the Bahamas just sold almost $1 billion worth of bonds at a nearly 8% interest rate, and that's partly because the country is only B rated, and they actually have to entice investors with those rates, especially because it's also not a diversified economy. It's totally dependent on COVID. On tourism, which COVID has kind of like destroyed because people aren't traveling or can't travel. So I think that all of these things combined make it so there's this kind of, before we get into the negative interest rates, there's this tale of two cities kind of thing, like there's two tiers of countries that can't print their own money, or they are poor, and they have to have higher interest rates during this downturn, and countries in the West, which have the advantage of having these huge central banks that can suppress these things. No, the problem with, and the reason I don't know if North America is going to have negative interest rates is we just talked about these interest rates here in the Bahamas. Well, if you're a Bahamian insurance company, and insurance is a big business here, even in a small economy, because, we're in a hurricane zone. So, like I buy insurance for my house every year. You can buy that government bond and get 8%. So the premiums don't have to go up a whole bunch, right? But if you're an insurance company in the United States or Canada, those rates go negative, you're just going to have to up the premium. So you could have these ridiculous premiums on houses, cars, life insurance, whatever it may be, because the insurance companies can't get any interest on their return of money. And then of course, the banks are the same way too. The banks really make a lot of their money, to oversimplify it, but a lot of their money borrowing, short term in the overnight window, then loaning out whatever their 5, 10, 15, 20, 30-year mortgages. And if these interest rates keep being suppressed, and all of a sudden, a 30-year mortgage is 2%, they're not making any money, because maybe they're borrowing at 0, but they're only lending out at 2, instead of, say, borrowing at 2 and lending out at 6 or 7 or 8, like they got a 2-point spread instead of a 6-point spread. And I think that's been seen. One reason that, if we look at the stock charts over the last 10 years of the banks in the U.S. after the financial crisis, or in Canada, a lot of those companies have done well. Even a few banks have hit new all-time highs, even with what happened in 2008, 2009. And that, I think it's partly because we didn't go that negative interest rate route. Banks still can make money off that that interest rate spread. But in Europe, they haven't been able to. They've had negative interest rates. Rates are super ultra low, even lower than the States and Canada. And I think the negative interest rate is the last gasp resort. Again, the banking industry, the housing industry, the insurance industry. Those negative interest rates wreck so many industries. I think what ends up happening is I think the central banks in North America, the central banks know that, and they're going to be in trouble if rates go higher. So rates go negative. So I think that will be a last gasp attempt. And again, if they do it, the last gasp will be, well, the debt in the States might be $40 trillion, and they're going to be like, well, we have to try to make this negative. Otherwise, the government's broke.
Well, also, what about pension funds in Canada and the U.S.? A lot of them were underfunded to begin with. Negative interest rates would wipe them out, wouldn't they?
Yeah, well, but see, the thing with that is that I think that what would happen more than likely is, and this is another danger of misallocation of capitals, is they would almost go, first of all, they would probably go buy bonds with these obscure countries. They might go buy Indian or Brazilian bonds or Bahamian bonds or whatever, because they're actually getting a real return on it. And also, that could also force them more into stocks, because they might say the stocks are precious metals. Pension funds might say, well, at least with these things we can get capital gain returns. In terms of stocks, at least we'll get maybe a small dividend. And we're not going to own bonds anymore. So I think more than the issue with the leaving pension funds or making them more unfunded, it would actually push them into riskier asset classes to try to keep themselves funded. And then, and the market is a crazy bubble as is, that would make the market even a more dangerous bubble, because if you had all these pension funds doing that, basically, essentially they'd be selling their bonds to the central banks and the governments and going into risk assets, that could lead to like this real blow off and crash, which in turn would cause those funds to be really, really underfunded. So that's another issue with the negative interest rates as well. It gets rid of asset allocation, because one thing that a pension fund is supposed to do, and they have these funds organized this way, is that as the workforce, they have more pensioners, they're actually supposed to go more into bonds to get return of capital and the small interest return over stocks. But then, and even the average individual is supposed to do that as well. But this might keep people into riskier asset classes because they can't get any return on their bonds. And by the way, it also hurts the economy. The theory behind all these zero rates is that, people can borrow cheap and they can get home mortgages and they can get all this credit for cheap, and it can create these asset booms. But one thing that Japan has showed is, as you get this aging population, one of the issues and the reason the Japanese economy has been weak for decades is that, again, the pensioners there have their money in bonds, and they're only getting 0.5% or if that on some long-term bonds. Whereas if they were getting 5%, it'd be like, do the quick math, if someone had $2 million in savings when they retired, 5% would give them $100,000 a year, basically cover their everyday living expenses. But at, half of 1%, they're getting, $10,000 a year. So I think that's another thing too, is it actually hurts a lot of the economy, because the people that are in fixed income aren't getting any return on their money, and then they turn in return to not spend any of that money, And I see that, by the way, this kind of thing I'm talking about with, the issues with the bonds or the whatnot, and people. And there's so many people I know who are 60, 65, 70, 75 years old who own Apple or Microsoft or big stocks. And I was just like, I've never seen that in the past. When I started, 20 years ago, when I was in my 20s, the older people I knew then that were kind of in retirement, they may be playing around a bit in the market, but they wouldn't have the majority of their money in these stocks because they, again, were retired.
We'll have more with David Skarica right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. We're speaking with David Skarica. David, of course, one of the reasons they say they're pushing for zero or negative rates is that it forces people into the stock market if they want to make money, or into gold and silver. Of course, that can be very risky as well.
Because gold and silver, the issue is you don't get any return on your capital, right? But I think too with gold and silver, I hate to be totally just bullish on something. You always like to look at the risks when you're investing in the sector. But when I see, again, what's going on with these governments, what's going on with what's going to happen in the economy, what's the finances, etc. It's hard for you somebody to not be positive on gold and silver because the governments aren't going to rein in spending. We're looking at both in Canada and the United States, even though we've rung up huge debts during COVID, both governments are talking about doing more stimulus, right? And maybe the potential for universal basic income, MMT. And this is at a time when the debt to GDP in both countries is getting well over 100%, when they're getting to this kind of what would normally be crisis levels in debt. So when I again look at what's going to happen with the current administration in Canada and in the States, I know that right now they're kind of in a fight because they're going into the election. But after the election, I think no matter who wins, and let's say for argument's sake, it is a Democratic sweep, the Democrats are going to go, I think one thing that people have to understand is the Democratic Party, maybe Biden historically has been a centrist, but the party itself is much more to the left. Just like I would tell people the Republican Party is no longer a conservative fiscal party, like Trump was blowing up the deficit even before COVID started. So, but the Democrats, I think, are going to do trillions and trillions of stimulus, which I cannot see being anything but positive for gold. Because again, it's going to be more money printing. The Fed is going to have to buy a lot of this debt, etc. So.
David, do you see the equity markets having a major correction this fall or perhaps a crash, or will they just chug on no matter who's in the White House?
Well, this actually kind of gets back to the stimulus. At first, I still think we're maybe in a topping formation. We've talked about this in the past. So much, the NASDAQ and the S&P are actually almost back at new highs, but so much of this is driven by a few of these big tech stocks. It's a very top-heavy market. I think actually the top 6 stocks in the S&P 500 have a larger percentage of the market cap than they've ever had ever. Even in 2000, when all those big tech stocks, kind of took up a lot of the market. So I think that when we're looking at that, we're kind of seeing the dangers of a bubble. But I think again, if you have all this mass stimulus, it's like interacting on the credit card, going whatever, drinking better, whatever analogy you want to use, is that you're going to feel great for the next year or two when that initial stimulus happens. But when the effects of that wear off, it's going to be disastrous. I think the biggest example of that was in 1933 when Roosevelt did a big stimulus and he tried to take it away in 37 and the economy went to a pretty steep recession. Unemployment went back to over 20% and the stock market fell 50%. And I think it was because that move from 33 to 37 was almost entirely driven by stimulus from the government, So, so I think this would even be worse because back then the debt was low. Roosevelt spent a lot, but the debt, it was coming from such a low level. The government was nowhere near, insolvency. But if we start this huge stimulus now, and some of the numbers I've seen are 6 to 7 trillion if there's a Democratic sweep, over the first 2 to 3 years. Well, if you combine that with the structural deficit's probably 1 or 2 trillion, the debt itself is 27 trillion, you're probably talking the debt being 40 trillion, by say 2023. So I think then the market may hold up because of all that stimulus. But I think the issue is after that, it's going to really swan dive. And I'm not saying it's going to hold up a year or two, but, whatever, it can hold up for 6 months, whatever the case may be. But then it'll really swan dive because after all that stimulus is over, it's going to be pretty apparent that was the only thing propping up the economy. And again, this is why I have another issue too, we talked about the stock market, in terms of consumer spending, business spending, unemployment. I don't think we're going back to normal in the post-COVID world. There's 2 factors for this. So many businesses, especially restaurants and service businesses, just cannot operate at 25% capacity or whatever the government wants you to do, right? And so that's number one, right? And number two is a lot of people, you have to think about the psychological effect COVID had. Why would you want to start a new restaurant or a new business now when you know that if anything like this happens, the government can just shut you down and, and you can't operate again. So, and they're not going to be any help to you as a business at all. They don't care about it at all, right? They care about the government employees. They'll keep paying them, but they don't care about you, someone in the private sector. So, I think these things, and I think this all factors in to what we're talking about, because it just means that the economy is still going to be weak. There's going to be bigger debt and deficits. There's going to be more money printing, and it's probably going to be higher, gold and precious metal prices. And the last factor that we haven't even touched on was you got the baby boomers retiring. So you have all of these structural things that are now going to be problems with the economy probably weaker longer term, and then new spending and stimulus, and maybe, like I said, like universal basic income at the time when all the baby boomers are going to be retiring. So you do have this kind of makings of this kind of like, I guess you could say, the perfect storm fiscally, where we can definitely see these things kind of unravel from the government standpoint. Yeah.
I'm at the very end of the tail boomer thing. Yes, all my friends have retired, and they've sold their homes in Vancouver, bought smaller properties in the interior of British Columbia, and they're hoping that the cash, that surplus that they have, will help in their retirement. But as we talked about low interest rates, maybe that cash won't be enough to keep them going.
Well, and another thing too, in terms of the cash, is I don't think the cash itself, because they're going to inflate everything. We all know they lie about inflation. Inflation is probably really like 6%. They say it's 1 or 2. When they're saying it because they want now, they're willing to go to 4 or 5 because they really want to inflate. It's probably going to really be 15 or 20, like it was in the 70s. And so what's really going to screw those people is if they're on pensions, their pensions are indexed, they're going to be getting an extra 3 or 4% a year, and really that is eroding at 20% a year. And I don't really care who you are, or how smart you are, or if you think that, oh man, I do have to buy gold and silver, I do have to buy stocks to kind of keep up with this inflation that's higher than what they're reporting. If you're 65 or 70, you're still going to want to keep a good chunk of your money in cash, right? So, so I just think that's going to be a real detrimental thing for the baby boomers. And like you said, I think that kind of, that kind of, another aspect of all of this, you're talking about them selling in Vancouver, going to the interior. I think that's, kind of an aspect you might see going forward too, is that if someone, these cities are struggling anyhow because of COVID or whatever, but if someone's living in a large city like Toronto or Vancouver or in the States, New York, wherever, let's say has had a large property boom in the last 20, 30 years, as they get older, I think, people are going to sell and try to move to kind of maybe more rural, smaller towns where the cost of living and the cost of housing is cheaper.
Plus, who wants to live in an abandoned city where the only people there are the beggars on the street corners?
Yeah, well, I think that's all an aspect. That's the social part of this, not just the economic part. That it does look like we're going into a phase again. See what happened in the 70s. Actually, I think it's almost going to be worse in a lot of ways because, again, the stretched finances of these governments. But we're going back to this thing where, remember, the 70s and 80s, a lot of these cities, and New York was the kind of most infamous one for that, but Los Angeles, you remember the LA riots and the violence that was in South Central. I remember going to Houston in the early 2000s, and I was walking around downtown, and they were kind of revitalizing Houston at that time, and people told me, like, you couldn't walk downtown 15 years ago, even in the middle of the day. It's just crackheads and drug addicts and, people everywhere. So I think that's another issue that's going on, too, is that a lot of these cities are going to kind of hollow out and are going to see very difficult times. So that's just another aspect of it, because how many people, live in these urban areas and say their main asset is, not everyone's a millionaire, right? Like someone's main asset might be, my little apartment in Chicago is worth $1 million. Well, what happens if that drops by 30 to 50% because of the issues these cities are going to have? So that just adds kind of fuel to the fire, in my opinion, of all of this. And again, what's the way out of it? It's inflation. It's like, well, if you're thinking that housing prices are going to drop 30 or 40%, what's inflated everything, that housing price can stay stable, but it's really, losing in inflation-adjusted terms. Last interesting note here is that I looked at the average housing price in the United States, and I'm assuming Canada would have been pretty similar from, the 60s until about 2000. And what was interesting was the best performing decade in nominal terms, so obviously not inflation-adjusted, but just the actual price increase wasn't the boom times of the 80s or 90s, the stock market was going up and the economy was pretty good. It was the 70s. You know why? Because inflation, remember, that means the cost, if you're wood, concrete, steel, copper, whatever you put into that house is going to cost more, which means at the end, the selling price has to go up, even if interest rates are higher or the whatnot. So, and the economy's bad too. Now, I'm not saying there's going to be a housing boom from these inflated levels, but what I am saying is, again, printing money and creating inflation might be a way for them to, say, at least prop up the inflated housing bubble that we have,
David, should people be taking a close look at junior gold miners right now because their production costs are way down, but gold is still worth a hell of a lot of money?
I think actually, and there's another aspect as well. Because of this kind of depressed precious metals market we had for the last 10 years, the majors have not been able to replace reserves. So any kind of junior miner that is creating reserves, that potentially is going to become a miner, or even a small producer that is producing gold, are going to be real takeover targets. And because they're still trading at quite depressed levels, if you consider that gold is whatever, 1,900, 200, 2,000 an ounce, I think a lot of these junior miners should be trading at much higher valuations. Should be trading at a few $100 million instead of, say, $50 million in some cases, right? So I think, junior mining sector, and I'm biased because I'm active in the sector. I do finance for companies. A friend of mine have a marketing service for a few companies, so we work on that side of it too. I do podcast interviews like this with executives of some of these companies. So, I am biased. I own shares, obviously, in a lot of them. But I think that one reason I am that invested in that sector is I do think there's a great opportunity now, especially as gold prices go higher. And then on top of that, here's the great thing about a junior miner. If you own Barrick or Newmont, gold prices now have to go higher for them to make money, right? Like, you're going to need gold to go to 25 or 3,000 for Barrick or Newmont to say double or triple in value. A junior miner at $1,900 gold with a new find can go through the roof. So even though we've talked about how I think gold and precious metals are going higher, at 2,000 gold, 25 silver, these things can make money here. We don't need higher gold prices. Remember, all we needed in the mid-90s when you had diamond fields and, of course, 3X and the 3X ended up being a fraud, but all you needed for the junior mining industry to boom back then was gold just had this little pop over 400, and that was enough for these junior miners to go crazy. If you go look at the mid-90s, there were a few years where, again, the seniors weren't doing very much, but the juniors actually boomed from about 93 to 96, So I think that, that's another aspect of the junior miners that's really positive. They really don't need significantly higher prices from here. At 2,000 gold and 25 silver, they can make a lot of money and a lot of cash flow. So I look for companies. I like companies. Really, three types of companies I look for just to end up. I'm either looking for companies at really early stage, just because it's cheap. Because I said I buy financing. So if I can get something in the first tier financing that has a very tight share structure, only at a market cap 10, 20 million, I love that because there's tons of upside. Even if they don't even have a property in it yet, because I can roll a quality property into it. They have good management, and that quality property could cause the stock to go up 5 or 10-fold. Then I also look for the actual, what I want in companies is, I usually, at this phase when we're still kind of earlier on in the bull market, I want companies with ounces in the ground. So, even a company like this, a new deal, I would like them to take over a property that, say, has a resource, has ounces in the ground. And the last thing is maybe near production. So, if you got a company that is just about to go into production, that phase where it goes from being a late stage exploration company into being a producing company, that can really cause a company to boom. because all of a sudden you got cash flow, you got more money, the company doesn't have to dilute anymore because of the cash flow and the profits they're making, and they don't have to do financings anymore. And then, being a producing property that gets more attractive for maybe a takeover. So that's the three things I kind of look for, or three types of companies I kind of look for, right?
David, thank you so much for chatting with us.
Thanks for having me.
My guest has been David Skarica, founder of the Addicted to Profits newsletter online at addictedtoprofits.net. He was speaking to us from the Bahamas. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Chris Vermeulen, and David Skarica. And thank you for listening. If you have any comments for the show or questions for our guests, you can send them to info@housestreet.com. Now stand by for a company showcase update from American Manganese CEO and President Larry Reaugh. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HouseStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, CEO and President of American Manganese. Welcome back to the show, Larry.
Thanks, Jim.
Larry, did you have some new news to tell us about this week?
Well, we had a press release out on October the 15th, and I'm probably going to talk most of my podcast here about that, because when we put it out, I could have swore that I said that we were rejected. But a great kudo for us is that we were given participation in the Canadian secondary battery R&D mission to South Korea. And what does that mean? That means it opens up a whole avenue of battery manufacturers and EV car manufacturers in Korea to introduce them to our product. And actually, some of the South Korean companies that will be looking at this, we already have NDAs with. But that's only some of them. So there's, as far as I'm concerned, it's a great opportunity for the company and the shareholders. And we're basically in there because of our collaboration and grants that we received from the National Research Council Industrial Research Program, which is IRAP, and so that shows that IRAP thinks that we've got something worth talking about. These will be tailored for business meetings with Korean companies to discuss R&D collaboration opportunities, something we've been trying to do for the past 2 years. So to me, it's kind of fallen by the side that nobody's really understood what we're talking about. And Zarko will be presenting on October 21st. It's a sold-out event, and we'll have presentation from other companies. Now, there's other companies such as LG Chem, Samsung, SD4, and SK Innovation, just to name a few. The missions, the objective is to focus on Canadian companies to potential Korean partners for industrial R&D and potential future commercialization. So that's very important. R&D collaboration includes validation, adoption, or joint development of Canadian technology in Korea or other markets. So, this is, to me, is the fantastic opportunity for the company. We'll get to talk to a whole room full of, it'll be virtual, but we get to talk to a whole room full of Korean people that are in the EV manufacturing and recycling area in Korea. And so South Korea, I should say. So anyway, the whole thing is going to be fantastic for us. We're looking forward to it. We're looking forward for the responses that we may get from that meeting.
and it should be something that the shareholders should look forward to. So basically, Jim, we're getting recognized around the world, and only be at some time in the near future. It may not be Korea, but it may be somebody else that steps up to the plate and wants to joint venture our whole project. For example, we had meetings in Quemetco yesterday and did a tour of the pilot plant with a major company that invests in the green scheme, and the green scheme does include recycling. So you're seeing lots of information out there on recycling now. You're seeing companies that are talking about building plants. Nobody has a clue to what their performance and recoveries and purities are, but they're going to build a plant. Well, we've spent over $7 million on our R&D, and we were one of the first ones out of the chute and one of the first ones to ever get patents. So we got 2 patents, and that's been basically the foundation of all the work that we're doing. I know people get a little depressed because we're optimizing and everything like that, but they have to remember the time to optimize is before you build the plant. You don't want to build a plant and find out that you've got something is wrong, something you should have found out. And the actuality is that we're close to coming to the end of that, so we can get started on our design and move forward. So I just wanted to point out some of the salient points in that press release that seem to have been overlooked, and certainly it brought on, as usual, our press releases bring on a lot of selling. And I don't have to go into the predator trading to remind you where that comes from. But anyway, we're happy, and we've got things to look forward to every week. Hopefully we'll have some announcements on what's happening with our spin-out, particularly maybe on the 43-101 report next week sometime, but we'll just have to wait for that. Jim, that's kind of what I wanted to say, except have a good weekend here. It's blowing and raining and cold, but I don't plan on going out anyway, so that's okay with me.
Larry, so many governments now are mandating that only electric cars will be sold by a certain date, a decade or so down the road. How important is that to your company?
Oh, super important. They're talking about, getting rid of gas cars in probably the next few years, totally get rid of them, have nothing but electric vehicles or their fuel cells, that sort of a technology that will also be moving along, but I think electric vehicles have got everything else beat hand down. And what does that mean? That means more cars, more batteries, and not only that, Jim, submarines, ships, airplanes, you name it. Everybody's going electric.
Larry, for people new to American Manganese, what's the company all about?
The company is a critical metals company that developed a process for manganese back in 2009 to, 2012. We got it patented, and that's for treating of low grades of manganese. And remember that manganese is important, very important to the U.S., and we took that patent and we evolved it into a patent for treating lithium-ion batteries. Simple. And it sounds simple. Our initial tests were great, and but to get it all finalized into the hands of the patent offices and into the hands of potential investors has taken time. But we're doing everything right, and so I can't apologize for that. We move on to that. We're a company that's listed on the venture exchange under the symbol AMY. We're listed in the U.S. under the symbol AMYZF. We're listed in Frankfurt under the symbol 2AM. We have a website out there called Manganese, Inc., and if you go to that website, you can do all the diligence that you need to do. We try to keep that well up to date and supplied. And you can contact the company here at 778-574-4444. And you can contact me at LREAUGH@AMYMN.com.
Larry, thank you so much for the update.
You're welcome, Jim.
My guest has been Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on October 16th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.